Morning, Julia.
Welcome to our USC Due Diligence Webinar run by the Executive Education here at Marshall. My name is Julia Plotz. I'm an assistant professor here at USC in the Marshall School of Business. I've been teaching in the corporate finance area since 2002. Prior to that, I worked in investment banking, and I actually worked for Bank of America Securities, so I had some experience sort of on the transactional side, doing due diligence for mergers and acquisitions. At USC, I primarily teach MBAs, undergrads, executive MBAs in corporate finance and valuation, financial statement analysis. And so I'm excited to be here and to be working with Jay Jasklard, who's our practitioner from Deloitte. Jay, do you want to talk a little bit about your background?
Sure. Thanks, Julia. My name is Jay Jasklard. I'm with Deloitte Advisory Services. We're involved in transaction support, including buy-side support. I'm involved personally with market analysis, competitive analysis, and financial modeling, valuation, and commercial diligence, which is the subject of the webinar. Glad to be here.
Thank you. So today we were hoping to make this a teaser for a larger due diligence workshop that we have on April 30th, which we will mention sort of at the end of our presentation today. The purpose of our webinar, as I said, is to sort of give you an idea of the types of topics that will be covered at the larger boot camp. It's also very important to Jay and I that we answer specific questions that our audience has here in the webinar so that we can tailor our program to your needs. And so today what we wanted to talk about is just give an overview of the various diligence disciplines. We'll kind of do an overview of what commercial due diligence is, which is one of the smaller aspects of our larger program, and try to give some sense of the types of things that Jay and I think are important for you. We're targeting this to the buy-side process, and so certain red flags, things that you need to consider. Obviously, since we're both have a valuation focus, we'll be focused on how do you actually vet the target company that you're looking at, how do you make sure that you're thinking of the appropriate considerations when you're doing the negotiation process on price. We're also going to try, even though we've been working on this probably for about a year now, I think, we've had the idea about doing one of these sessions. And so obviously a lot's changed in a year. And so what we also want to do is really try to incorporate current market conditions, lessons learned, things that should be taken into consideration when you're doing due diligence in this current market.
Absolutely.
So the other important thing I want to mention is that Jay and I really want this to be tailored towards the audience. So if you have any questions at all during this webinar, please interrupt us. You have an email address on your slides, execed@marshall.usc.edu. Send questions directly to that email, and then they'll be announced to Jay and I so that we can approach your questions specifically. So the purpose, again, of this webinar is to really empower individuals on the buy side in the M&A process. It's a part of our larger boot camp at USC. As I mentioned, we're going to try to make this very relevant to today's market. In terms of the different diligence disciplines that are going to be covered in the larger boot camp, we have all sorts of areas. So we have experts from Deloitte and from our USC accounting program, accounting school, that are going to be talking about tax and implications for due diligence, also sort of special accounting issues. Jay and I will be covering a few of these issues as well. And then we have a whole section on human capital, thinking about employment contracts, pensions, labor, retention, culture, all of these things that arise in the due diligence process. And then the commercial due diligence area is the one that Jay and I are going to spend some time sort of giving you an overview of today. As it mentions, this list is by no means exhaustive, and this is why it's important to obviously be in contact with practitioners who can best advise you, and that's really what Jay does for a living, is comes in and helps buyers think about all the different issues that need to be considered. So I think at this point, maybe Jay, you want to talk a little bit about an overview of what commercial due diligence is?
Sure. Thanks, Julia. As Julia said, the purpose of the boot camp and this webinar is not to be exhaustive. That is to try to provide our practitioners that are listening on this, that attend the boot camp, with some fundamentals that they can in turn adapt to the various facts and circumstances of the transaction that they're working. On this webinar, we'd like to get into a little bit of CDD, as we call it, commercial diligence, and talk about, Julie and I just want to talk about some of the things that we're going to cover more in depth during the boot camp. But when we typically think about commercial due diligence, or sometimes called vendor due diligence, we think about a buyer that is engaged with the seller and trying to analyze the seller's business plan and look for value drivers and the risks of the value drivers. We're looking at, the buyer typically has a thesis when they're looking at an investment, either to buy or a joint venture, but there's typically an investment thesis. The buyer is going to outlay typically millions, sometimes, and for larger transactions, hundreds of millions or billions of dollars, and they like a return. They, the investors, would like a return on the investment. So diligence is the process of confirming the thesis, vetting the seller's business plan, and seeing if the price points are in sync. The ultimate goal, as we say here of CDD, Julia, is, as we both know, we want an independent, unbiased understanding of the seller's business plan, what is possible, what's not, and where the gaps are in terms of the seller's view of the world versus the buyer's. We typically include here, we look at market trends, we look at the industry in which the buyer operates, we look at market trends, we look at customer perception of the product, the brand, the services, whatever they provide. We talk about customer stickiness and what customers want and what alternatives customers have with respect to our seller. And then finally, we talk about competitive trends. We talk about where our seller fits with its competition. Are his products able to get better pricing? Do they have better customer stickiness? Things like this drive value. And the buyer wants to reconcile the gaps between how the buyer sees it versus the seller and how that translates into value. So next slide. From Julie and I's perspective, I think we both agree, Julia, for CDD to be compelling, it needs to be relevant. Typically, we see a very general model that the seller may provide with high-level growth trends, and I think the buyer owes it to itself, the investors, to really get into some granular detail and vet what's driving these high-level projections. So we look at in our boot camp, we're going to talk more about what we call revenue synergies or revenue growth, as opposed to what we see in some transactions where people justify it based on cost synergies. We can let go of the finance department and save some money, or we can let go of some sales reps. In the long term, as we've talked about, that's not really as compelling as revenue growth, which drives companies. So CDD is typically, as we say here, scope specific, but it focuses on typically revenue and the growth opportunities that the seller has. And we look to validate those growth assumptions, things like volume, pricing, margin, look at the pipeline, what new products are going to come online. Are they accretive to the business? Or are they simply cannibalizing current products? We look at that. We try to conduct some interviews with customers that are available. If we can do that, I'll say clandestinely, we can do that to get a feel for what the seller's position is in the market. And again, the point here is to highlight specific risks that impact projections, and by extension, that can impact value.
So I have a question, actually. I know one of the things that we cover in our finance and accounting classes is, a lot of students come in and they understand income statement drivers, they understand revenue, they understand costs, but they have less understanding or familiarity with thinking about how the balance sheet works and thinking about the quality of assets. I know in the due diligence process, this is a really important thing, okay, trying to vet the quality of the assets,
Absolutely.
The ability for those assets to generate future revenue. Also, I think this idea that there can be hidden liabilities or there can be some risks associated with it. Can you talk about maybe how, as a practitioner, how as an advisor, you help companies in that aspect of the quality of the assets and hidden liabilities?
I think that typically when you're starting diligence, you're looking at two things. One, the state of the company now, and you say the balance sheet and the quality of earnings. And two, what direction is the company going? So the starting point can simply be the financial diligence in terms of if you work your way down the balance sheet, you're looking at obviously cash equivalents, and AR. I think more importantly, as you work down, some companies have built themselves up through the procurement of intellectual property and goodwill. A lot of that is, obviously in the current accounting world, those types of balances are tested. But I think part of CDD and financial due diligence where they converge is what is the legitimate strength of the IP or the goodwill in the market today? It might have been purchased historically at a price point that may not be valid today. So I think that the practitioner, the buyer, we'll talk about the buyer, the buyer's advisors, needs to vet we talk about IP, we could be talking about patents, customer relationships. How strong and tenable are they? And that is where it comes to interviews, not only with the seller, obviously, but the folks that are in the trade, as we say.
The industry
in
knowledge.
The industry. And we talk about stickiness and how, if the customer relationships aren't that sticky, then you need to question if there's a big slug of intellectual property on their balance sheet related to customers, and your analysis is finding that they're not that sticky and they have a lot of alternatives. The quality of that asset may not be where it's at on the balance sheet. Same with goodwill. A lot of time, we tend to call that air, because a lot of it may not be tenable and supportable. So as the buyer, when you're looking at the quality of those assets, because we live in an intellectual property world, I think it's important to look at the underlying assumptions, because that goodwill and IP is all about the future forecasts, and beating the competition to justify those assets. And if you don't see that in the market, you need to be skeptical of those types of assets. On the liability side, again, product warranties, deferred revenue liability that you may have, that you as the buyer, you'll assume certain liabilities, to the seller's customers. Those need to be vetted as well. What do you legitimately owe the customer from a legal perspective? What contracts are you assuming? And you need to vet those. Yeah. You can't just assume that, okay, well, we'll deal with it post-close. You need to do the best you can to vet it up front and understand what you're going to be obligated to post-close. I think those are important.
That's great.
Just as we say here to finish this slide, commercial, Julie and I's during this webinar and obviously during our broader boot camp are going to talk extensively about going beyond what we call easy handles of just pulling an analyst report, a broad industry report on pharmaceuticals or manufacturing from S&P. And there's nothing wrong with those reports in and of themselves, but typically a seller operates in a niche or a sector within a broader industry, and that's where you need to focus your efforts. So we want to encourage practitioners that are on the webinar to go beyond that and to dig into the details, because as the buyer, as we both know, consultants get to walk away, but the buyer has to live with what they buy. They have to live with it, and so it pays to dig into what you're going to buy.
And I think, when I talk about, when I teach my students about how to value companies, I think this final point about trying to understand the different characteristics between companies in terms of these quality aspects and maybe special opportunities that they have. I think we have a question actually online.
Yeah. What trends are we seeing in the market today with deal volume declining? If you could repeat the question, please.
So
what trends are we seeing in the market as it relates to deal volume declining? And it's interesting because I think, we hear that, we're obviously in this environment where we're seeing potentially no transactions or less transactions in some industries, but then we're also seeing some industries that are still having a pretty robust merger and acquisition environment. Obviously, one of the biggest issues is the ability to finance acquisitions, and so obviously companies that are sitting on cash and liquidity are in a better position. Do you want to talk about some of the trends you're seeing right now that are maybe a little bit different than what you saw 6 to 12 months ago?
Sure. I think transaction volume generally is down. I would agree with you, Julia. I think companies that had a large cash balance and comparatively little debt are doing well and getting good deals. I think personally, empirically, I'm seeing a lot of alternative, what I'll call transaction structures, like a joint venture or an in-licensing or out-licensing arrangement that reduces the financial obligation of either side. And you have in pharma and a lot of heavy R&D industries, a lot of collaborative agreements that, again, at least at the inception, reduce the financial outlay of either side, but allow it to continue to a point where value is, where either side can appreciate value a little more clearly, and then a transaction can maybe be evaluated at that time. So yeah, deal volume's down, but there are alternative things that companies can do.
Sort of like instead of doing outright acquisition, taking control of an asset, companies still want to enhance their business. They can do a joint venture or a partnership. You eliminate sort of some of that upfront risk, and so it's. I think that's good.
Do we have any other questions in the queue right now, Jack? No. Okay.
So let's talk about some of the red flags that on the buy side we should think about. Jay, when you were talking about the importance of really understanding the revenue drivers. We always hear this from management. Oh, we're growing at 20%. We're doing this, we're doing that. I think especially in this environment, when you look at recent historical revenue growth, and then the idea about trying to forecast forward, we're in a different environment. And so I guess one question is how do you actually get to the bottom of a projection that a seller is giving? We're going to grow at 20%. How can you really get to the bottom of that?
I think we often see a SIM, or the practitioners on the webinar probably, some of them used to seeing a confidential memorandum prepared by an advisor that talks about the seller gives a business plan, typically in macro terms, and then provides a forecast, and you'll see a revenue top line, and we have here a red flag, we'll go 20%. We often see the hockey stick.
Yeah.
And that drives the seller's expectation of value, of the selling price. I think commercial diligence starts at that point. When you start to see the hockey stick, you see the revenue projection, you say, okay, I need to build that up. I need to build that up by customers. I need to build that up as the buyer best I can by product. Because there's some things for, obviously, antitrust purposes you won't get access to. But the buyer needs to be as creative as it can in building that up in terms of where are the customers concentrated, how sticky are they? We'll talk about that in a bit. And then what products are they selling to these customers? And if you're not seeing customers buying at 20% volume or growth, then you need to ask yourself, okay, is the seller bringing on new customers? And if they're not, then at least in the near term, the buyer needs to ask itself, what does that mean in terms of value? If they're only growing 5%, because they don't have a new product coming online, the customers are going to kind of buy the same as they were last year. There's no real new major customers because 20% is a big bump. If you're not seeing that, then you need to question, what does that mean in terms of value? What does that mean in terms of the multiple I apply and the price that I negotiate? But I think it needs to be building up the revenue forecast, at least in the medium term, by triangulating between R&D and clients and product.
And I also think, I know that we've talked about in our longer session, sort of discussing how the competitive environment affects this sort of vetting this revenue growth. When you think about what's the target's market share, who are they competing with, are there risks that they're going to lose some of their market share? So I think that's also an important point that we need to think about.
Absolutely.
Another thing I think that we wanted to talk about, an important aspect about commercial due diligence, is thinking about when you're looking at valuation multiples in the market, right? So when you're looking at past transactions, when you're looking at maybe a peer company or competitor that was acquired at a certain multiple, I think we need to be very careful in this environment because we're seeing an overall shift in valuation across the board. And so we have this red flag. We want 8 times our pro forma EBITDA to sell the company despite negative margins last year.
Everything's perfect.
Yeah.
I think, and this is a good one, I think we can go back and forth and have a lot of fun with because we see this so much, but in prior years, there was so much money chasing targets that it was really a seller's market, and the banks were lending at 8, 9, 10, 11 times EBITDA and very favorable rates, and those days are gone. And I think today, with not a lot of diligence, and there was private equity competing with trade buyers, strategic industry buyers were competing with money from financial or private equity buyers, and that would drive prices up.
That's really gone away for the moment, right? When we think about the robust market we had of financial buyers, venture capital, private equity, that's kind of dried up for the moment. So I think that's a pretty key point.
And I think that commercial banks that would syndicate these broad private equity loans, Julia, I think my experience is, I think the banks are going to, meaning the commercial banks that lend, are going to do a lot more diligence themselves now on their own and beef up that. And I think they're going to lend at lower multiples. So I think from a buyer's perspective, it's going to, if you're an aggressive buyer and you need credit, you need commercial, you need leverage to buy, it's going to be harder to come by. Your commercial banker is going to expect a lot more and be much more conservative. And I think that the sellers are going to have to lower, I won't say have to, but I think expectations need to be lower because there's going to be fewer dollars chasing the sellers. I think the buyers have, in today's market, a little advantage because 1, markets are down, and 2, there's not as many people bidding up bidding up assets.
Well, I think, when we think about the relevance of a due diligence session, this idea that as a buyer, you really potentially have opportunity to negotiate on price more than you had in the past. I think this red flag is especially important to think about, because often we look at historical multiples, we look at comparable transactions, and I think we're in a completely different place now. Another red flag.
If you want to, just to go back to that, I think that sometimes practitioners, if they see a deal done last month at 8 times, and maybe the seller's kind of like that company, so I should do an 8. I'm a big fan. Just like we talked about vetting the revenue, you need to really vet and put side by side. If you see a transaction done at 8 times EBITDA, you need to compare that seller or that company that was bought to what you're buying. And if you can't line up the margins, if you can't line up the growth, if you're below that, as a buyer, you're diluting value if you're going to pay 8 times for something that maybe should be 5.
Right.
So again, the diligence should be can I substantiate the multiple? All else being equal, you pay a higher multiple for a better company.
Yeah.
But don't just take the average, or don't just take the last deal. Allow that to kind of put you into a range.
Sure. Look at the specifics of the asset you're buying. And this really leads in, I think, to our next point, which is paying a premium for a best-of-breed, actually still on red flag number 3, paying a premium best-of-breed multiple for an asset that has average characteristics.
Right.
This is basically what you're talking about. For people that are on the webinar, I think, we use this term best-of-breed in evaluation or investing context. An idea is, like you said, Jay, if you're looking at a company that has superior return on equity, superior profit margins, a better product, a better service, better management team, quality of the assets, you're going to pay a premium for that.
And there's nothing wrong with that.
Yeah, absolutely not. You get what you pay for to some extent, but we don't want to pay a premium multiple for an asset that maybe is not best of breed.
Right.
I think that's a key point.
And we've got the point of diligence is to determine where you sit on that spectrum of, am I average, am I a dog? Is this company heading towards liquidation, or we can get a really good deal, or is this legitimately a market leader with better margins, with a better R&D pipeline, whatever the best of breed is in that particular sector? It's the buyer's job, or the buyer ought to figure that out, qualitatively and quantitatively.
And it'll help them in their post-acquisition integration as well, understanding, I guess, whether or not it's going to be a complementary acquisition. Our final red flag, I think that's our final one, is really thinking, this is sort of like I'm trying to think of what we call this. This is, buyer is so interested in the deal that they sort of get emotional over it or overpay or misjudge risk. And so I think, I know when we talk about valuation here in our courses at USC, this is the point that leads any of our discussion about M&A, that you should never, make investments unless they're going to enhance shareholder value. Right. So, what do you think about this point? I guess, what's the takeaway?
Well, one thing here is this red flag is IRR, internal rate of return. And for the folks on the webinar that may not know, you basically, for all your capital allocations, Julie, as you know, there's typically a hurdle rate. If you're going to invest in CapEx, in real property or personal property or intellectual property, you're expecting a return. When you buy a company, you as the buyer have a certain hurdle rate you expect. Let's call that 15%. And that should be a big part of your process. If you can't find cash flows that at 15% make it accretive or neutral at the worst, then we typically recommend that people walk away or negotiate down. What we sometimes see is once the cash flows have been vetted, and let's say the company's hurdle rate is 15%, the price they pay implies an internal rate of return of 10. And you're kind of scratching your head. They should walk away, but a lot of deals were done at very low IRRs in industries that historically have been in the high, let's say you get done at an IRR of 10, but if you're in the pharmaceutical or tech space, the typical cost of capital or hurdle rate's in the high teens. So if you're doing transactions at 10%, if your model, you've vetted the cash flows and you're still running through and you've got to plug in 11, 10% to get to the price you're going to pay, you need to take a hard look at, how, quote, strategic. We hear the word strategy and synergy, which don't mean a whole lot with an IRR of 10%. you need to take a look at your assumption if you really want to do that deal. So for me, this is about IRR and vetting the forecasts.
I think also, when we talk about current market conditions, I think buyers also have to consider, has their hurdle rate changed at all, right? Access to capital is it's a much tougher market. Unless a company has access, they have their financing locked in long term, or they have a lot of cash sitting on a balance sheet, I think they really need to reevaluate some of the deals that maybe they did in the past, and consider whether they should, change their hurdle rate or think about that a little bit differently.
I think the hurdle rate should be a living, breathing part of an acquisition strategy, and a hurdle rate can be, let's say you have a public company, and we'll just use an example, say Johnson & Johnson, big company. They're a portfolio of many different devices, drugs, over-the-counter pharmaceuticals. So let's just say a simple example. Let's say Johnson & Johnson's hurdle rate is 12%, but not every investment may be evaluated on that 12%. They may be investing in something, a very speculative device. Exactly.
Human health or devices.
So that needs to be, typically companies that are on top of this will vet the strength of the investment based on the risk and how that fits in, as you say, to a fluid, evolving hurdle rate that a company has, because it should evolve with the market. And you need to evaluate it. If I'm buying a riskier asset, how does that fit into my portfolio? What does that mean to my consolidated hurdle rate? And am I consistently evaluating the rate of return that I want on my investments? And every investment should be judged in that optic, in my opinion.
Yeah. I think from a valuation context too, we talk a lot about thinking about divisional cost of capital, which is sort of your point. If Disney is going to acquire a video game company, then you'd like to have them judging that acquisition from the appropriate risk. Do we have another question, actually, from the audience?
Yes. Are we seeing more earnouts, in your opinion? Okay,
so for an earnout, for those in the audience who maybe aren't familiar with that term, an earnout is a way to structure the price of an acquisition, the price that's paid. So if I'm acquiring Jay's company and I have concerns maybe about this hockey stick growth projection that he's given me, we may be in a point where we can negotiate, and I can say to him, listen, Jay, if what you're telling me is true, if you can meet these targets on sales, EBITDA, various measures, then let's structure the purchase price in that way. I'll pay you the multiple that you're expecting for the quality of your business. I'll pay you some up front, and then I'll pay the rest over a period of time as you meet those or achieve those targets. So, Jay, are you, as a practitioner, are you seeing earnouts? Are you seeing? I know when I was working as an investment banker, we saw a lot of earnouts structured for smaller acquisitions, for obviously private companies that were being acquired, maybe even in cases where we wanted the management team to stick around. What are you seeing right now?
I would agree with that premise that typically it's normally it's more prevalent when let's say a public company is buying a private company and information is more difficult to procure. I think we continue to see, at least with my experience in transactions that I've touched, you typically see in the pharmaceutical, medical device, technology space where there's some speculation around the pipeline and getting a product to market, and there may be some pretty risky assets that could be potentially very accretive, or they could die in the pipeline, and you could terminate the R&D project. So I think that a buyer, what I'm seeing is, again, this goes back to what we talked about at the very beginning. Buyers with a lot of cash have the advantage right now. They don't need leverage, and if there's a gap between what the seller wants and the buyer still wants perhaps the core assets, the buyer I think, is in a position in today's market to structure a transaction based on, again, achievement of certain levels of earnings, or getting a product approved by the FDA, getting a chip, or a phone to market on time, things like that. That, again, if there's a gap, you can reward them if they make it, and you give them some incentive to the seller to stay on and keep working. But if it doesn't, you're not diluting. Again, getting back to hurdle rate, you're not diluting yourself. So I think a judicious buyer uses the earnout to kind of bridge that maybe 25, 30% gap in value if it's there. And I think that, again, just to wrap this, you talked about earlier, I think for public companies or U.S. companies under U.S. GAAP, I think earnouts are going to become a little bit more prevalent due to increased disclosure requirements on transaction accounting. It's called FASB Standard 141R.
No, don't get into this.
I'm not going to get into accounting class, but it will change for SEC registrants, for people reporting under GAAP, the amount of disclosure for their transactions. So I think if there's a big gap, I think registrants that are buyers are going to be more.
You have opportunities.
They're going to have opportunity, right, to use earnouts more because they if there's some question and some uncertainty, and given the disclosure requirements, I think they're going to opt to say, okay, let's structure this creatively and so that both sides can win.
Yeah. Well, I think we're getting to be out of time on this webinar, which is great because I think this just shows that we have a lot more that we could talk about in a full session. We have, various kind of lessons learned from the credit crisis, current market conditions. I think a lot of these things we've sort of touched on a little bit today. And obviously, the key thing here is that a deal could be derailed at any stage. The surety of getting the deal done has become as important as price. And maybe the fact that there's opportunities as a result to negotiate a little bit more. As we said, it's a buyer's market. I want to get to, we have a slide in here with information on our actual due diligence boot camp. And Jay just actually flipped past. We have both of our contact information is available. So please, for our audience, if you have any questions for either me or Jay, feel free to contact us either the telephone or email. And then our actual full session, our due diligence boot camp, where we'll be talking about tax and human capital and accounting, all the different areas, and also getting into a little bit more detail about this area.
Right.
It's going to be Thursday, April 30th, 8:30 to 5 here at USC. It's a $750 registration, and we have a website here that has more details.
And I think on this, before we wrap up, it's for all practitioners. So if you're strong in, say, tax, they will get in the tax-specific breakout. They will get into some meat that I think that the tax practitioner will find stimulating. But I think, like most people involved in the M&A cycle in their companies, it's nice to have a little bit, have as many tools as you can in your toolkit. So it's designed to accommodate someone that's a generalist or a specialist, for the day and learn something about these various disciplines.
Well, thank you, Jay, for coming and taking time out of your busy schedule to come over to USC.
It's been great.
It's been great talking about due diligence, and I look forward to April 30th.
Mutually. Thank you, Julia.